it's Ivy Slater, and you're listening to Her Success Story Podcast, a show where gutsy businesswomen share their success journey. Hi, this is Ivy Slater. Welcome to today's episode of Her Success Story. Today, I am excited to bring you an amazing person I met at the Women's Tech Conference in New York. Ann Winget is the founder of Alternative Wealth Partners, a Dallas-based private equity firm focused on blended portfolios of alternative assets. Alternative Wealth Partners was launched in August of 2020 in the middle of the pandemic, which I love the initiative and the innovation and the forethought of Ann's vision. It's laser focused on marketing private equity understandable and accessible to Main Street investors. And I really want to talk to you about this so much, Kellyanne, because we think private equity is, those are the big guys. And I say that in jest, but not so in jest, right?
Yes.
That's different. So thank you for joining me on Her Success Story. Take me back to the beginning. How did you get involved in this? Before we even get into how you opened Alternative Wealth Partners, what's your background? How did you get involved in this?
So I've been in the alternative space for almost 15 years, and I wasn't always in private equity or finance or anything like that. I actually had a completely untraditional route to this space, and it was all because I wanted an expensive pair of jeans at 15, like every teenager. And instead of my parents getting it for me, I had to go get a job. And so I went out and figured out the sales game very early. I was selling car washes part-time in high school and making almost six figures. So
Wow.
doing taxes since I was 16 and, spending money like a crazy person as a teenager. I don't think any teenager should have that access to money at free will. But because of that, I wanted to have a lot of independence. So, I graduated high school. I had a U-Haul the day I graduated, had my own apartment, had multiple jobs. I worked in healthcare, worked in demolition, and then ultimately found my way into oil and gas, which I think I was predestined to be in anyways. I'm five generations in the space in general. So I was going to end up there, whether I liked it or not. And that was my first
And it
exposure.
helps that you're from Dallas and it's part of the culture there.
Oh yeah, I'm from Texas. I lived in Texas basically my whole life. I did a brief stint in California, did my time over there, and came back to Texas, as I think most people do. um,
And then
so,
you came home.
and then I came home, and so this is where I've been. I moved back to Dallas in 2018, and I've generally been self-employed since the time I was 21. So I saw a business coach or a business uh, consultant run a project and walk away with a six-figure check, and I was like, I want that, and was told that you
You
can't
do
just
that.
you just can't be a business consultant. I said, yes, sure I can. And no one ever told me no, probably is my problem. But I went out on my own, a young 20-year-old, and just built up a lot of experience working underneath other people, building up their reputations, their client base, their books of business. And then in 2020, decided to get out on my own completely.
When you stepped out on your own, opening a private equity company, what was some of the first things you realized you had to do to make this work? And you did this during the pandemic, which I give you huge kudos to, because so many people, I'll always say every obstacle presents opportunity. And obviously, I'm not the first one to say that, but I will say, going back on my own career, my own life, every obstacle has presented opportunity. And hopefully I've noticed it along the journey. Um, not everybody sees that. And it takes an incredible thought leader to actually step into it, and somebody with some guts.
Mhm. I think that COVID presented a lot of opportunity for people who maybe felt like there was some security being like underneath somebody else. And I was working with a family office, and I was just recognizing things that I just didn't want to be a part of anymore. And COVID presented the opportunity to be able to just be like, I don't and step away because there wasn't really a risk of like losing everything. Everybody was kind of put on pause during this time. It gave people a lot of opportunity to find clarity and like maybe purpose. And I think that's what it was for me, anyways. Um, I remember separating from the family office, the firm, and literally the next day registering alternative wealth partners. It was I had this idea, I slept on it, woke up the next day and did it. And because things were moving slowly, right? Not a lot of business was going on. People were trying to figure out like, is the world going to stay shut down? Texas never really shut down. So, um, business was kind of as usual here, which was nice, but slower pace because the rest of the world was trying to still figure things out. There were a ton of businesses created in COVID. So I think that it was a great opportunity for people that needed kind of the swift kick in the butt because I had been told multiple times the years leading up to this that I should go out on my own. You need to be doing this. You need to have a fund. You need to do this. And I was like, I'm not ready. I'm not ready. I'm not ready. And then it was that moment. I was like, okay, now I can take the risk, whether it fails or not. This is my opportunity to try.
And once you made the decision, where was the first thing you did? I mean, the first thing you have to do is raise capital, right?
I
We, and you had a wealth of knowledge. You had done an enormous amount. And anybody who has not picked up Kellyanne's book, you do want to pick it up and get the full backstory. I've really enjoyed the read. But in getting started, okay, saying, okay, I'm going to own a private equity firm. I need to start raising capital, not at the 10,000, but at the 100,000 plus.
mm,
Where did you get started? And how did you make that work for you?
so most people would try to go find the money first and then the deals, but because I had this um large network of deal people and things that I'd worked on in the past, founders that I'd like to follow, had helped raise capital on previous projects of theirs. I really wanted to structure the deals first. I wanted to make sure that I had the preferential access to really nice deals before I went out and tried to raise capital because I have no track record at this point, right? It was all under somebody else. And some of those things being private family offices are the track records I can't talk about, right? And the things that they invested in and the money where it came from, and also non competes and other people's access to clients. Like I can't call those investors and ask them for money. So I was hit with a lot of those challenges. So I'm like, how do I come out of nowhere and ask somebody for $100,000, right? Which was our minimum in our first fund. Now it's 250, right? So I went and spent about 6 months, took a while to like put together, the first couple assets. And I leveraged my own relationships, my own capital to get those access to deals. So my fund was actually already generating, it's a small amount, but it's generating revenue before I even raised a dollar because I had put assets in there first.
Yeah.
Uh, I had to start making relationships with new people. And because I had a network of estate attorneys, CPAs, wealth managers, things like that, that I was able to go out to those networks and be like, hey, I have this alternative strategy, hasn't been done before. I never saw a product out there that leveraged the tax incentives from direct asset ownership and venture. So I'm going to blend it together and present it out to the world. And they supported that. And so through that network, I was able to raise our first $17 million dollars in about 18 months. Um,
Nice job.
Thank you. With no track record, I'm just some random 30-year-old, that was like, I have this crazy idea. I hope people believe me. And since then, we've paid out 9.25% to investors. We've provided tax incentives to basically write down 100% of their investment. Um,
Nice.
and we've doubled our portfolio value in 2 years. So we've gotten really aggressive and now we have track record. So now we're on fund number three, the second vintage of our diversified strategy. We have a little bit of a track record and now, we're going a little bit more institutional. But in that time, right, this is 4 years later, There's been a lot more access to information, which is kind of the whole point, right? Private equity seems so elusive and no one had any access to it. It was only for family office or like the ultra high net worth. Uh, when
Correct.
in when in reality, it's for anyone that has $1 million net worth, which there's millions of people in the United States that do, or a six-figure income over 200 grand, which millions of people do. They have access to invest in alternatives. And so, a big piece of what we do is that investor education piece.
So when you talk about doing the investor education piece, um, do you educate like one by one? Are you doing it at a large, like it's I one of the things that's hitting home for me is when you look at business in the United States, you look at family wealth in the United States, you have more families that are at that $1 million mark. You have more incomes if you kind of look at your big cities that are in, not your average United States income is with or whatever that 50, 60,000, but yet you have many, many people in your cities earning $250,000 and up. So how are you doing? Are you doing this person by person, which seems insane?
Sometimes it does feel like it's person to person. Um, there's a lot of you're competing with a lot of the big financial firms.
Yeah.
You're competing with RIAs. You're competing with all the different, and in my book, I discuss all of this, right? There's a difference between your financial advisor and a financial planner and like all these different things. So, like navigating the financial services space is difficult on its own. So, trying to,
Touche.
yeah, but trying to educate like groups of people is like very hard, but that's why I'm so public about like what I'm doing and trying to challenge people's status quo of thinking around private wealth, and partnering with those large firms of like, I know you can't talk about this, but let me talk to your client base about alternatives because you're never going to be able to do that. And it's a disservice to your clients to not allow them access to that information.
So what drove you to write Pitch the Bitch?
I was having a lot of the same conversations over and over and over again.
Yeah.
And while I don't mind having 30, 45-minute conversations with investors about all of this stuff, right? It's not sustainable long term.
Mhm.
And so I wanted to kind of put it in the book, right? I wanted to put it in a space that was like, here's all this information that you need to know at least surface level about that's unbiased in the book. I don't care what you're doing with your money, but I need you to care about it and to think about it. And like that's the point of the book. And it's to think about it in a way that's not that doesn't create barriers. Just because you don't make $250,000 today or you're not worth $1 million today doesn't mean that you don't have the potential to have that later. And when you do come to that point, you need to be not confused, which is our problem now. And women specifically who have been excluded from the conversation since the beginning of time. Like I don't think women could have a business bank account or something until the 80s without a other person's signer on it and stuff. So like I
Yeah,
obviously
I will actually go in there and say when I opened my own printing company, I had been in business with my father for quite a while, and when I went and when we were we had merged and etc. And then I was going out on my own a bunch of years later. And if my father did not have the relationship with the bank, there was no way they would have opened the account, which was a huge hurdle, but I would not have had access to a credit line or anything else. And it had nothing to do with my father's money or where our old company was. It was I couldn't have gotten the meeting. I could not have gotten the meeting. So when you say, yes, the 80s, and yes, I graduated college in 84, and, I do a lot of shout outs to my mom. The first thing she said is, she goes, go get an, when I got my first job, she goes, go get an Amex in your own name and never give it up, no matter what. And I still have that same Amex.
yeah.
Yes, it's really important for women to understand where we've come. I'm getting passionate on this in my own, but I've been in the journey. It's really important. We have to have our own credit. We have to have a knowledge around money.
And it's being gate kept from us. And it's on purpose because they want to, there's a lot of control in that. The amount of money, and it changes every day because everybody's wealth increases every day. But we're talking about tens of trillions of dollars being passed down to the next generation over the next decade. And right now we're 52% of the population. So, just number wise, that's a significant amount of money that's changing hands and probably gender.
Yeah.
And a lot of people have no idea what to do with that. Um, and the numbers around women changing financial advisors after they lose their loved one or their parent is insane. I think it's like 80%
Yeah.
of men leave their financial advisor within 6 months of um, divorce, widow, or inheritance. And it's like, well, what do? They sit on cash, which is terrible because they don't know who to trust. And the problem is that the financial advice, like the financial services space in general, is also not a very trustworthy place. Only 16% of financial professionals are women. So it's hard to find us. And so we just have to be loud about it. And women need to start taking ownership of that. And that's what the book is about. Like, it's okay that you don't know this, but you know it now. So do something about it.
And what do you see? So I want to just kind of cover some differentials for our listeners who don't know or haven't been exposed. You're a private equity company. You reference family office, and also sitting in this space is venture capital.
Mm-hmm.
So can we talk a little bit about who's who in the space and where this is going? Because I think that we it would be helpful to take that moment of pause here so everybody understands, because people, as they're scaling the company, I need this, but do they truly know what they need or what they want or what would be helpful?
Yeah. So to think about it is that like private equity is really the asset class, and the type of capital that's being deployed gets spread against like venture, then your growth, and then your like buyout space. And most people relate private equity to the buyout space where you're
Correct.
doing mergers and acquisitions, you're buying companies, you're going public. Like this is all in the later stage private equity. Venture has now kind of created its own beast and sits kind of standalone away from private equity, even though it's still technically under the same asset class. Venture is going to be your startup space. This is going to be your high risk. It could be an idea that someone has. It could be an existing product that's like, I've created a, a viable product, but it's not like mass produced, and I need capital to like go find a manufacturer, or I need to hire developers and like start scaling this, and or I need to do marketing to bring customers. Like that's all in the venture space. And venture is the kind of the most accessible piece of all this because you can go in with, there's angel network groups out there that can go into a venture fund or a venture opportunity for as little as $1,000. Where private equity, when you're talking about mergers, acquisitions, buyout stuff, like you're talking about hundreds of millions of dollars needed to do those projects. I kind of sit in the middle of that, where I have access to $100 million projects, where because of my relationships in the family office space, I can write $1 million check into that and have access, or I can go in and I can invest at the venture level of $100,000. Most funds aren't doing both. I like to blend because there's incentives on both sides for the investor to take advantage of. On the private equity side, the later stage stuff, you can direct invest inside of a business, inside of a piece of property, and get the tax advantages that are associated with that type of investment. And then you get the equity upside of like doing something more high risk like venture, and then blending those together for a blended return. I like to say that we're the venture fund that pays dividends.
I love that.
And family offices, like this is how family offices work. Like if you're a traditional family office, this is how you're invested. You have your insurance, you have your public equities exposure, but for the most part, 99% of your time is spent on your private equity alternative strategy. You're buying real estate, you're buying businesses, you're running businesses. A lot of family offices have their own operational business, which is where their money came from. Like the wealth was actually created from like a manufacturer, an industrial project, or a tech company. In the last like 15 years, you have a lot of new wealth that was built from like, oh, I sold my cybersecurity company, or whatever, and I made $500 million. Now they're starting to like do that. I do a lot of work inside of the family office governance space of that generational transition and what people are invested in now.
What do you see for the future of this space? Where are things going? What is changing? What is evolving?
I think that like the shift between what venture capital was 10, 15 years ago and what it is now is very different. Um, you had like true professionals in the venture space because they came from private equity, right? They did their private equity time and now they're like, we have all this capital, we want to put a little bit more risk, we want to create new businesses. And that's where venture capital came in. Now, because we had these like little exits of employees or like first time founders or you know, they had like a venture class at Stanford. You have these people that call themselves venture capitalists, right? But they're inexperienced from the operator side. So they're just throwing money at different opportunities that sound great, hoping that, one out of the 100 investments they make 100 X's, right? Um, I think it's extremely high risk. There's a lot of inexperience there because of I compare it to like the gurus of real estate, right? There were real estate investors who invested before 2008, right? Who are real estate investors. Then there's the investors that got involved after 2008, okay?
Okay.
These people at least recognized that there was an opportunity to come into real estate when it was down, right? But then there were the real estate investors that came in like 2016 who are like, oh, you can make a lot of money in real estate and I can syndicate and use other people's money and do all this stuff. But they've never actually experienced any sort of true market correction in real estate.
Right.
They've only been invested for less than 10 years. I compare that to like what's going on in venture right now. You have all these people like, oh, I can invest in venture for $1,000, or like I can syndicate other people's money and like do an SPV and invest in this project. And get my little management fee or my acquisition fee. And so you have these syndicators in both spaces that are like trying to learn the space, but haven't actually experienced a correction. Like what just happened in venture this last 18 months might be the closest thing to like a 2008 of the real estate space, where there's a lot of corrections happening. The people that are experienced um, and understand and sophisticated in the venture space will survive what's happening in venture right now. The ones who won't. And I think that that's the correction that's happening. Same thing happened in oil and gas. People that invested wanted to get in 2014 when it went to $130 a barrel. We're all excited about it. Those companies did not survive the correction to $30 a barrel. So you have all these different things that are happening. Private equity is a lot more like this because it hasn't changed. Like there's not overpayment on valuations for later stage companies. It's typically going to be 3 to 10x what revenue or maybe even EBITDA. And like they're all operators. Like you have a bunch of people who are entrepreneurs and operators that are in the private equity space. And so I think like now they've realized, oh, I can take this experience and put it into venture. And family office is also doing this because they have young people taking over the family offices. And what do young people want to do? They all want to be entrepreneurs and they have the capital to support them, which is very different than most entrepreneurs that have existed today who've had to like bootstrap their way into oblivion.
It's interesting and fascinating in in watching in stepping back and watching it all. And actually, my husband and I were talking, and something came up about the market, and the concern in the marketplace, et cetera, et cetera. And I referenced, I said, my father always told me when the market is low, have the cash to buy.
Mm-hmm. Oh yeah.
And that is, I was in a meeting a couple of years ago. I had spoken at a large company and did a debrief meeting afterwards. And somebody came in and asked one of the people at the meeting about, oh, let me ask you about the market. And I said, I can answer that. And they're like, oh, let the business coach answer this. What do you have to say? I was like, it's going to go up. It's going to go down. It's going to go back up. It's going to go back down. Are we looking at 10, 20, 30, 40, or 50 years? Because it's going to hit it all. It's
Yes.
a matter of, um, I truly encourage more than anything, I encourage women to know and step into and it doesn't mean you have to come into a venture capital, you have to invest in private equity. any of the above, but be open to learning. Most importantly, learn about our money and how we handle our money and what options are available to us. And don't let anybody, Kelly, one thing you said before that resonates for me is I've never let anybody tell me something I can't do.
Yeah, I think that it's important for people to remember that this is all made up. Everything we're doing is made up. So, um, like you have to start thinking about things that way. Whatever you want to have exist, you can make that happen. It just you're gonna have more like hurdles to overcome than others based on what your privilege and walk of life is. But ultimately, if you want to do something, just do it. There's really nothing that can tell you you can't, unless it's somebody that's trying to keep you from it.
Yeah.
It's not necessarily mean that you cannot do it.
What is one thing that has surprised you in this journey?
Um, I think that a couple things. One was when I first opened the fund, um, just how just how much people like trusted me when I got in the room. And having never known me, I never known what I've done. Um, but it gave me a huge insight into what people were actually looking for when it came to like making an investment decision, because it was always like me trying to convince somebody about a certain type of project or a certain type of investment. And this one was really about getting people to rally around me as a fund manager, because the strategy changes every day. That's the point of active management. The world could turn upside down tomorrow, which it did over the last 18 months. And how do you navigate those changes? And so convincing somebody that you're the race, you're the horse to bet on in the race, and having that positive feedback of like, I believe in you, like that was like a really cool thing to experience. um and then also to see that, unfortunately, the most disappointing kind of lessons that I've learned have been, men not following through. uh so on in capital. So one thing that women should actually be really, proud of themselves for is that they stay very consistent with their decisions, um and they lose less money because of it. Overall, their portfolios earn somewhere between half to a point and a half more, like a percent and a half more every year. And compounded over your lifetime of your portfolio can be pretty significant, just because they don't move their money around. They make a decision and they stick to it, and they don't complain about it. They don't worry about it, or at least externally worry about it.
Right. I hear you.
And they don't make emotional decisions after they've decided something. And men do not do this with their more risky investments. So when you're talking about alternatives, you're in the private space now. There's not publicly accessible information constantly. There's not a lot of oversight, and you're trusting, the people that you've invested in.
Trust
And
is big.
yeah, so there's a little bit more perceived risk there. Men are uncomfortable in that, and women are not. Um, and that's something that I've learned, how to navigate those conversations, because the men are going to be the ones that are going to be asking for a lot of insight constantly, even though they've written checks a quarter of the size of their wives. And that's a personal experience that I've had. So understanding that women, you should have confidence because you do make good decisions, because it's proven. You make the decision, it makes more money, and it's okay. And you don't have to worry about it. The men will worry about it for you. Your husband will worry about it for you.
What is the one tip you could share forward with our listeners in building your company, in where you're going next, and what you have navigated to get where you are today?
I this is my most useful piece of advice, so I try to give it a lot too, is that you just need to fail fast. Like don't spend a lot of time trying to fix something if it's not working. Like move on to the next solution, maybe work on a different project and come back to it.
Yeah.
There's just a lot of wasted time and money when you just like constantly try to put that square peg in a circle hole or whatever. So fail fast is really important, and have confidence that you know what you're doing, because you probably have twice the experience of everybody else around you.
I love that. Kellyanne Winget, thank you so much for joining me today on Her Success Story. You are a wealth of knowledge as well as a wealth of inspiration.
Thank you. Thank you for having me.
Listeners, I will always say one thing at this time. Take a breath. Think about the interview, think about the conversation, and what was your number one takeaway? The number one piece that resonated for you, and then make your decision on what you're going to do about it. Thanks for joining me here today, and stay tuned for more great episodes of Her Success Story. If you enjoyed this episode, please share it forward with friends, colleagues, as well as hit subscribe to be in your inbox every Monday morning. See you next time.